trade only when we are in the profit zone. Yeah, this is the edge that we have. So we're finding our zones. That's one of the edges that we have probably over retail traders all the time. We are looking for an area to trade in. And the other thing is when we get to this area, there's another edge because we are still waiting on a manipulation pattern to happen. So there's like a double edged sword sort of a thing but it's both in our favor. So think of this whenever you are looking for trades, because you've learned an edge, so use this edge now. Yeah, that's important. And then this is what it is. We need resistance and support, and we need a trend line. And we need it to be qualified and untested. What do you think is a qualified resistance or a qualified support area on the chart? You can just type in the answer there, what you think it is. Perfect. Justin says that it is the touches that makes the level a qualified area. Two touches minimum. Yes, that's correct. Okay, so we are looking for touches. That is what qualifies the resistance or qualifies the support. And the same goes for the trend line. It's the touches on the trend line. But what, okay, let me just, the next one. So we need our two touches, and then that becomes a qualified resistance. So what makes it now an untested resistance? So we know when it's qualified is when there are two touches. But what makes it an untested resistance? Because this is now another part of the edge. Okay, what makes it an untested resistance means that profits hasn't been taken. So if your idea was to go short, so we've come into the resistance, we see we have our two touches there, so it makes it qualified. But this one is it has been tested already because it's come up to the level and it's created whatever we are looking for, and it's come down and it's taken already 1/3 down toward the target here. This is halfway through, and then this is all the way through to the target. So an untested resistance is when prices has come down and it's already taken out profits, which means that the potential stop losses above here are now already taken out. It doesn't mean that it's 100% guarantee that the guys who's traded short here has put the stops here and it's now moved their stops down and it's a guarantee that they've taken it out. It's just more likely that a lot of them would have taken their profits out. And we're going to assume that they are taking their profits out, or at least some of it, at 1/3 of the distance between here and the target area. Do you understand what I mean with untested resistance and untested support? Okay, so here prices are Say, for instance, prices has come down once and then it's come down twice. So we have our qualified resistance. So it's qualified because we have two touches here, and this isn't breast, yeah. This is this is this is support that is a qualified support area, yeah. So what I mean is now we can start looking for a stop hunt in this area now, because we are in an area that is qualified. Now what I mean is, has prices, when they gone long here, has it gone through 1/3 of the distance between here and the target now? And if that is the case, we're going to assume that the guys who's put their stops here has probably moved it up now and they've taken out some profit, which means for us, when it comes back here, we don't really want to trade there. It doesn't mean that we can't. Yeah, it just means that this is now an area that already been tested. Profits has been already taken from this area. Before, when we look to the left here, when we look left, when that hasn't happened yet, yeah. So what we have here is now prices still hasn't moved. Sorry. I'm going through the whole thing for you already. Those bloody breasts are still there on the screen. So what I mean here is that this could be a target up here. This is perhaps your 1/3 of the distance between here and going here. And that's halfway through. Yeah. This is 100% through from the distance between here and here. What I'm saying is that this is now a qualified support level and it's just touching, which means the stops here are still intact. But if this area has been tested and prices is going up and it goes through 1/3 of this distance, then we're going to assume that these guys' stops are now moved up nice and safely above here. So whatever happens here now is no longer a stop hunting situation, because we're going to assume that they've moved their stops up. So that is what I mean by an untested resistance. Means that nobody's taken their profits yet, and it's all an assumption. Yeah, so you understand that now, yeah? So to make this a level again to look at, all we do is we're looking for another 2 touches. 1, 2. Now we start again. Now we can look again. As long as it doesn't go up to the 1/3, we can assume that that is still an area for us to look at trading. Okay. Okay. How do you feel about that now? Do you understand that? Perfect. Okay, so we need a qualified area based on the touches, and we need it to be an untested area of resistance or support. Now, it just adds to our edge to the whole sort of a system that we are trying to implement. Okay, so we are always looking for M's and W patterns here. Now, those M's and W patterns are manipulations and it is the edge. You can call it what you want. You can say it's a stop hunt or it's just a pattern in the market. It could be the iceberg order on the top there or an iceberg at the bottom. But the pattern is going to remain the same. It's going to look like an M or a W before we want to pull the trigger. Now, the distance between the points there on the M and the W is what a lot of people ask questions about. So it makes a high there, and they want to know maybe the divergence, the distance between here and there, or the distance between that and that. Yeah. So I like using between, I mean, it varies, but maybe between 2 hours and 5 hour distance between the two would be nice. But if there's a distance, a massive distance like this, it's also fine. Prices are making highs there, making higher highs, and then doing another thing there, and then starting again. And, so that becomes something new now. That's what I don't like when the distance is too far apart. But it doesn't mean that it's not going to work out there. But I prefer a distance between 2 to 5 hours. Yeah. Between the 2 points of that M pattern. Okay, so the entry system number 1 is the one that you've learnt, the one that comes from the beginner strategy. Prices are making highs all the time. It puts in the midpoint of the M. It makes a higher high. And at the same time, the RSI is diverged. The RSI at these same points are making lows. So in that case, we have a RSI divergence entry. So we'll put our entries here and our stop losses somewhere above there. So this is the one we know. But what we're looking for is always this pattern. It's always an M pattern. No matter how big the pattern is, it's always going to be an M. And when we are going long, it's going to be a W. And then use both your edges here. Use the edge as in you are looking for an entry and look for this pattern in the correct zone. That using both edges are going to improve the chances of a good trade. Now we're going to use the fib trap. Again, with all of the strategies, we are looking for an M or a W, irrespective of how wide these 2 points are on the M. We are identifying the M and the W. So if prices are coming up into it, you need a low somehow, and then there is some sort of an M. But if this went 1/3 down, and obviously that's not right, but we can identify the M pattern there, irrespective of how wide that is. So the fib trap, we're going to use 123.6 Fibonacci and 161.8 Fibonacci. We're looking for our M pattern and prices are making highs. Prices are making a higher high just over here, comes low to the midpoint, and then it makes another high. And in this case, there is no divergence. So now we don't have a beginner strategy because there's no divergence. But what we're going to do, instead of divergence qualifying that entry at the M there, we are going to use That's your midpoint there. So from the high over here down to there, you draw a Fibonacci. And the qualifier is going to be when the next leg goes all the way up till past the 100%. 100% is here when we start the fib, when we draw the fib going down. And then if prices comes up toward the 123.6 and it's unable to close there, then this is a qualified M pattern. You can take the entry the same as you would do with the divergent beginner strategy. So prices are coming up till past the 123.6. It clips it or it goes above it, but it's unable to close there. So it's a candle that doesn't close and then it comes down, then unable to ever pass that point again. And then if prices are coming down and it passes that point, use the same beginner strategy method. But then the qualifier instead of the RSI is now a 123.6. I'm going to show you an example on the chart also later. So that's one of the Fibonacci qualifiers. It's like an extension, yes, but you're still using the same fib tool. You're not using the Fibonacci extension tool. I'll show you on the chart. Right? So now the next Fibonacci qualifier is prices are still making higher highs. And this is the 100%. 100% means this is the highest the chart has gone at that point. Then you draw the fib down to the 0 to the midpoint of the M. And then your Fibonacci tool will go past the 121% all the way up to 161.8. Then you look for the same thing here. Unable to close above here and messing around in this area. And if it comes all the way down through your midpoint of the M, then again the same entry is taken here. So prices comes down through the level and past this point now, and then that's your entry. So what it does, it's going to take away the subjectivity of how your M should look like. So with the RSI version of this, with the beginner strategy version, you see the M pattern could be very mad. You know, we can't take this one because it goes past the 161.8. So now you know that this is probably trending the other way and you don't feel like risking in that area. So if you have something to look for, then it's an edge for you. It's easier just to leave the chart when you see that this is trending too high. You've got this barrier here now. The 161.8 is a barrier. And in the other version, you have your 123.8 barrier over here. So the leg here has certain rules now. Unless you have your RSI and you still have a divergence. So you have now 3 different entries within the zone based on this sort of follow-through system. How far can this leg follow through before your trade becomes a nullified idea? This is what this system helps you with. So the common denominator or the common factor amongst this sort of trade, what is this common denominator that I'm looking for here? What is it that I'm on about with what was common among in the pattern of this that I just showed you? I think Gavin and Justin might know because they are used to trading like stop-ons and situations like that. But what was the common thing, the theme in that sort of trading? Yeah, that's great. The breakout traders were caught there. So we meant there and we cannot close. Yeah. So the breakout traders, Gavin says, were taken out, which means there was a follow through. So each of these trades had a follow through. Now, the next sort of trades that we're going to cover entries with is the failure to follow through. We're still looking for the M and a W pattern here. The M and the W is still an edge, but this time we're going to look for the failure to follow through. Like what we have here now is prices making highs and higher highs, and then it comes into the zone and it makes another high. But instead of following through with this, it fails to follow through. The trend doesn't follow through. So there's no follow through on this method. But now the issue comes in again here with the ambiguity and how far this should pull back. When should I take this trade and when shouldn't I take this trade? That's the question here, because when we come to our chart and we want to pull the trigger, we don't want to have any sort of second thoughts. We want to pull the trigger when we see the setup happening. When you see what you want, then you need to take the trade immediately. No questions asked. But now, there's such a lot of things that we can talk about here. The distance between the 2 points is one of them. And then the other point is how far this pullback should go. Now, in this system, we're going to teach you that the furthest up, the furthest retracement that we can get there is going to be a 78.6 retracement. We don't want this pullback to go too low here, and we don't want it to go too high and then smash down. We like a 78.6 retracement, the touch there and then down. Okay. So it's an M pattern, but the M is more formulated. Your eyes are going to be, you're going to practice searching for this entry. Muscle memory of the brain is going to look for that sort of a thing. You'll be able to see 78.6 easy, and it happens a lot of the times. So it's not that you're going to get less trades now because of looking only for 78.6. It's a qualified M which fails to follow through. So the failure to follow through fails at 78.6. Right, before we go ahead here, let us just make sure that you understand that. Yeah, do you understand the 78.6 failure? Okay, perfect. All right. So the types of traders that we have, yeah, when we get to a certain level. When we get to an important level at our chart, what sort of traders what does traders normally do at these levels when prices are coming into a level of importance? Yeah. So number one, you get the qualified level there. So now prices are coming down into the level. Yeah. Our first sort of a trader that does anything here, he acts off from this level without any further confirmation. This is a support level. The guy who acts here is waiting on the level to be hit, and he acts at this level. He's a level trader. He doesn't care about any confirmation further than prices hits the level. So prices hits the level, it creates entry cheese. This is Mark Chapman. So who creates the entry cheese? It's the level trader. He creates the entry cheese. He makes that entry cheese happen. He's an aggressive sort of a guy because he doesn't look for any confirmation. The next sort of trader that we have when we get to a level is a guy that he likes a breakout. And what is he breaking out? He's breaking the support. He has a completely different view to the level trader. His view is completely different. The level trader, he wants to base his idea that we are going to change the trend now, because this is a support level. He has the idea that he wants to break the trend going down and he wants to aggressively go long. So he places his entry and he has his stops there. Then we have the breakout trader. His view is completely changed. He wants to go along with the trend. He wants to, at the level of support, break through that support level. So now we have two sorts of traders there. And both of them are very aggressive. However, the breakout trader probably is waiting to break that level there first. Then we have one last sort of a trader, and this guy is a retracement trader. He also wants to go short the same as the breakout trader. But he wants some confirmation that he's in the right way, that short is the right direction. So he is looking for a retracement. Doesn't matter which level, maybe 50%, maybe 78.6%, maybe he doesn't want a retracement that high. Maybe he wants a retracement, at 21%. It doesn't matter, but what he wants is any sort of a confirmation that we are still going to go short. Say a retracement, and then he wants to trade short. And then he'll put his stops up there. So we have those three sorts of traders that does his thing at the level. So this is where the fifth method now of getting into a trade is, yeah. The first one was the divergence trap. The other ones were the fib traps, the two there. And then I forgot what the fourth one was, but this is the fifth one. Does anyone know what the fourth one was? It was the failure to follow through, the 78.6 failure. Yeah. So now the fifth one is the circle of liquidity. This is where all the traders are involved now. Yeah. So what we are waiting on here is prices to come into the level again and creates the entry cheese as prices comes down. So the level traders are coming into the level and creates the entry cheese, and they put their stops there. The next step is our breakout traders. They come down and they break through the level of support, and in the meantime also taking out the stops created by the level traders, the entry cheese. Next is our retracement trader, who's trying to follow the same idea going short as our breakout trader, but he is less aggressive. He's a conservative guy. He's looking now. He feels uncomfortable that he didn't trade alongside the breakout trader, because the breakout trader, he's got in at a better price. He's come down, and the retracement trader is looking for a better price to get in. And when it retraces up close to the level where the breakout trader has taken his trade, he feels very comfortable now if prices go short to also go short with him. But because he's a different sort of a guy, he places his stops closer around the area. So as we can see here, we have now 3 stops in a circle here. This is liquidity that's built up in this area. And once all 3 of these stops are taken out, breakout trader takes out his stops here, takes out the entry cheese guy, takes out the level trader stops. And then we, the big bank, takes out the retracement trader, and also it takes out the breakout trader. And once that 3 stops are taken out, the entry is there. That's the circle of liquidity. Must have all 3 stops taken out before entry. And then we have the conservative entry. For the conservative entry, we're going to need something that looks like a trend. Now, if we can identify a good trend with your 2 touches and all of that sort of thing, and the legs of the motive waves, and things are all conforming to Elliott wave theory, and we have momentum going on, everything you know about a trend, if you have this, then use that as your edge as well. So what we're going to need here is we're going to need to understand that the sellers are always in control in a downward trend until the last seller, the last strong seller, has been taken out. The last strong seller is identified as the traders who's put in the lowest of the low of that particular trend. These guys were strong enough to make a completely new low based on this trend. So we do not trade based on the conservative entry long unless this is completely taken out. So no long trades, irrespective of what happens in between here. You get your setups, you get everything, no long trades based on the conservative entry. This is how you need to develop yourself as a trader, finding out, are you conservative or are you an aggressive trader? And then master the entries. Find out who you are first, then master the entry. And then do that consistently. and then you will make money. It needs consistency. Don't chop and change. Once we have this whole fund management thing happening soon. If you want to start, whenever you want to start, let me know. But by that time, know who you are already. Yeah, because there is going to be situations when you get this, when you get your setup happening there and everything is perfect for you to go long. But the sellers are still in control. If you are a conservative guy, you don't bother about that. There is no FOMO, there is nothing. You in it to win it. You in it to make money. And you are a conservative trader, you don't take that trade. We're going to talk like personally, one-on-one on what sort of a trader you are. Before you go on to the fund management thing, we need to clear all of these things up already. But for now, obviously, you're going to practice all the different entries. Yeah. For now, you're going to feel for yourself what sort of a trader you have become. Let me show you this before I start preaching on that. Yeah. Okay, so a conservative trader, he doesn't trade against this trend until the controllers of that trend has been taken out. And the controller is the traders who were strong enough to make a new low, and that low stays there. Sellers are in control. Then we have our sellers suddenly broken out. Now, in this case, the conservative trader is still not going to take a trade. He is a conservative guy. He's not going to break out on this trade here. He's not doing that. Yeah? The conservative trader is waiting for a break and a close above the guys that has been recently taken out. They were strong enough to push prices. Remember, there's a lot of sellers here, many sellers based on this guy. Everyone is waiting here. So if the buyers has so much power to push through the sellers and hold prices up there, meaning close, then we are waiting. The conservative trader is waiting for another step. He's waiting on a pullback. He wants a better price now. He becomes the pullback trader here. And then it pulls back. It could pull back anywhere as long as it doesn't close below this area here. So it pulls back here all the way down, or it pulls back anywhere. You can pull back 21.6. You can pull back your 38%. You can pull back 50%. Doesn't matter. But we need to see the entry only happening after this. Do you see how conservative this guy is? He wants such a lot of confirmation. Then the conservative entry could turn a little bit aggressive by putting his stop here now, once he's entered here, or he can really go back to his personality and put his stop all the way back here, because he's convinced now that this is a trend change. He's convinced this is a trend change. So that is your conservative entry, which could now turn aggressive here or remain conservative by putting your entry here. That's for next time, yeah, the risk. We're going to quickly go to the chart and look for some examples of how this works. Let me just ask you guys if you have any questions on any of those. So when prices comes up into a level of importance, into a zone, when prices comes into any of these zones here, we look for 6 different opportunities to get into the trade. 6 different entry methods to get into the trade. You're already not just jumping in because you are looking for qualified and untested areas. And you are so convinced that your area is a proper resistance, it's been tested and qualified. You're really looking for any excuse to get yourself short when you're reaching this area. So edge number 1 is your zone. And this looks like a Z as well. It looks like a zone. So step number 1, nothing works without this areas being tested and qualified. Your eyes are probably already adjusted to trying to find these zones. I've looked at your charts on the Discord and it looks as if everyone finds these areas good. Yeah, they are. All the areas are perfect. So now let us quickly go to a chart example. Okay, in the group quickly, which direction would you like to have traded there at when it hit the 36 EMA? Would you like long or short? Yeah, that's easily done now because you see the direction and you're doing a top-down analysis on your chart. So you can see that when you get to the certain level, you want to sell. Yeah. And then you look to the left here and you see, oh, it's 64.50. And then you draw another level and it could be somewhere there. It coincides with your 12. It has some touches there. And perhaps if you go to the monthly, you'll even see some more things happening there. So we are in a good area. We have a nice playing field. We're dropping down to the daily and we can see, oh my God, this looks great. As prices comes up into this level of importance, you said you want to sell. And it comes up and it clips the 200 EMA. There's nothing else that you want to do other than looking for a sell based on what you saw on the weekly. You know your direction. You are convinced. You dropping down, you have your levels there. You can either go down to your normal chart to look for entries as prices hits your 200 EMA there. Or you can just go to the 15-minute on the normal chart. So this is your area of importance now. Yeah. So prices has come into, here's your line. Yeah. So you're looking in this area. This is a zone. You found the zone and you want to go short. And there's no RSI divergence here. So, but you are convinced you are in a perfect area. Right? So prices comes up, it makes this high, for instance. You take your Fibonacci and you pull that thing down. In this case, you have a 123.6. Prices are unable to come higher, messing around at the level, not even able to close there. And then your entry is just there. That's your 123.6. You've looked for that. You were looking as prices, if you look at it this way, prices are making highs in an area and you found and you couldn't get in based on the RSI divergence. Prices makes highs, it comes down to this level and then it's going up and up and oh, you find, oh wow, it's not closing above the 123. It might be struggling there. And then you start getting white candles and then you can enter as you would normally do. Now, this one here is a failed 78.6 failure to follow through. The failure to follow through doesn't happen on this one. But this is how it works. Prices makes it higher, high, 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 high. And it fails to follow through. you pull down the fib to the midpoint, and it only gets to 61.8. It doesn't get to our 78.6. So we don't take that trade. That is an unqualified failure to follow through. Right, let me just delete this one to make it more clear. Yeah. And delete this one. Do you see that this one fails to follow through, but you don't take this trade because it comes all the way up. So you take your Fibonacci down to the midpoint of the M pattern. It doesn't get up to the 78.6. There you can see. Fails. Don't take the W. This is how I filter out the failure to follow through. Yeah, I'll go through it again as many times as you want. And Johirul, with the homework, we can talk for 4.5 hours on this one if you want, because I need you to know this. I don't take all failure to follow throughs. I take a failure to follow through at 786. And with that one, for the last few months now, I've been trading that trade mostly. And I absolutely love it. This one is not a good failure to follow through. Gavin, I want you to also pay attention to this here, because we know that this would be a failure to follow through, right? Because it doesn't go through, but it fails at the 786. It doesn't get to the 786. So I disqualify this as an entry for me. Let's see if there's any more on this chart. You know from our top-down approach what it is we were looking for already. We weren't looking for anything other than a sell. Yeah, we went to our daily. First of all, we looked here and we saw that we were right on our 36 EMA. Right on our 36, a perfect selling opportunity. We're drawing in our levels, and on the daily, not only does it match our 36 on the weekly, it also comes up to our 200 and it respects it, perfectly. So there is nothing else to do other than drop down to the 15-minute and look for any opportunity to sell in this sort of area. Let's see. I think there was another time when prices actually came through there on the daily. Yeah, it happened there. Like it looks like it happened there twice, sort of a thing. Let's just see. Like if we look at this one, if this was in an area of importance, then prices makes its highs up here, yeah, highest high, and then it suddenly breaks out. So what you do is you pull down the fib there, and then you see it gets through the 123.6 and closes above, but you still have one more chance, and it fails at the 161.8. And look at the respect at 161.8. It's enough to qualify this trade for me. Now, I'll sometimes even get in aggressively right close to this, and try and get a win situation before I would even normally enter here, because this would be my normal entry based on the strategy. But sometimes I'm so convinced based on price action here that I just take a trade right above here. Small trade here, and then I'll add my main position in when it actually gets through. Because remember that all these EMAs are in the way for me. If I'm trading here and I see there's an EMA, I'll think, oh no, I don't like this EMA here. I would have liked it to be on top so that I can feel comfortable trying to get to the next EMA. You understand? But what I'm saying is prices comes up, and Alex, he loves looking at these sort of patterns. He loves this. So find the highest high of this pattern, Alex. Yeah, you are in a zone, you have your area, you see prices are breaking out. So then you pull down your Fibonacci. What am I doing? I don't know where that one was, but we can find many others here in an area of importance. If it's in an area of importance and you are convinced of that area, then look for trades in an area. This is what I'm saying. And you have now 6 different sort of opportunities to try and find your an area of trying to find a reason to get into the market. Let's see if there's anything more. What was that chart, Justin? The one that I took the other day, and you still asked me what it was. Oh, was it the Swiss franc versus the yen? Oh, CAD versus Swiss franc. Okay. Okay, so the CAD versus the Swiss franc. I think it was this one. Prices are coming up into the level of importance here. Or was it there? I made only 200 pips. Yeah, it was there. So it was here. This is the area of importance here, right? We've highlighted that based on an excursion beyond the mean. And this happens around about the 4th of November or something close to that. This sort of a trade here is the circle of liquidity. You have your touches to the left. You have a level of importance here. Yeah. You have a circle of liquidity here, because in this area you have a breakout trader. So you have 1, 2 touches here, and then you have not a breakout, a level trader is waiting on the level to be respected again. So he creates some sort of an entry cheese there. If I lift that up a bit, then you will agree more. So prices are at a level, creates entry cheese going short. Then you have a breakout trader breaking out the level of resistance. Prices comes down. Your retracement trader wants to go back in, and he goes back in after that. He goes back short, or sorry, he's waiting for the better price, and he wants to go alongside the breakout trader. He puts his stops underneath here. And then once all of the stops are taken out here, we are going short. And you can see the M pattern is nice and small. So So when the M pattern looks nice and small, then I tend to like the trade much, much more. But that wasn't the actual entry that I've taken. It was more in the beginning of the month, but that was just another version of the, let me just go here. I don't take the trade on the 30-minute. Yeah, I just moved it there so that we can get to the area I'm looking for. You see, this is another one here where we have a circle of liquidity. This here is a level, and then we have our level trader just trading short, and then the breakout trader, and then the guy comes in, and retracement trader comes in. He wants to go long, and then as soon as all the stops are taken out, that's below here, we want to go short. But I think this was the area I was more on about, because here we can see it much nicer. So there we have some sort of a level, right? The level trader goes short there. Immediately he goes short after prices touching the level there. Then you get a breakout trader breaking out of the level, and then you get a retracement trader. He wants to go long, and he places his stops there. And then we go short. So that's all. The circle of liquidity is all sorts of traders are trapped. The three types of traders are trapped. The guy who creates the entry cheese over here, he is our level trader. He's taken out. His stops are up there. Yeah. Let me do it with a pen. So we have the level qualified. We are in the zone and everything. Yeah. Then we have our entry cheese guy here. He's our level trader. He creates that entry cheese there, makes as if prices are going short. He doesn't, he's just basing it off on that level. He wants to go short. He's generally in the right direction, but it's too early. Then you get our breakout trader who breaks out through the level. Then you get our retracement trader. He's waiting for a better price to go long. So he can go long as far as he wants. He can go short or long. Short. What I mean by short is he can cut his buying off there, or he can go a bit higher. Then he comes down and he takes out the stops created there, and then the conservative way is to enter there. But we're still looking for the M. We are just trying to measure the M. We are trying to train our brains and our eyes not to look for that sort of a thing. Or if it is doing this, we want to know exactly where to cut that off before we start nullifying that whole idea. It doesn't matter if that thing works out eventually, but you're not going to be able to justify it. You must be able to justify why you got into the trade. And those are very good traders who can justify the reason why. And justification is the edge. Now, the good thing of what we are doing here is we're justifying not only our entry, because these sort of things happens all over the chart. Yeah, you get entries anywhere on the chart, and you can make money looking at just the entry and taking it. But what we are doing is we're adding another edge, and that is our zone. So when this sort of thing happens in a zone, your chances are just much, much better to make money in this game. So there's 6 entries that works much better in a zone. So the most important thing, guys, is find that zone, find that reason in the first place. Why do you want to get in? And we are using the weekly chart for our playing field, and then we are trying to find the direction and all that from the daily and 4 hourly. Now we need to go over the 4 hourly sort of charts as well, because that's where we find our first trending sort of trade. Let me just delete this. So what we have here is the barrier that we have. So where was this identified on? On which chart was this identified? Okay. And to measure the distance between this and this, where did we find that first? Yeah, it's on the weekly. To find where the playing field was, we went on our weekly chart. Yeah. That we found on our weekly chart. Then on our daily chart, we've looked for an excursion beyond the mean here, and we were looking for a trade to get in. And we placed our stop loss there. And if we had more trades going on here somehow, then you even place your stop up there as safely as possible. And that there was trade number 1. Your stop hunt there. That was found on your daily. And then you had the idea to trade all the way down short up until this zone here. And this again was identified already on your weekly. With your playing field, you knew that you had 200 pips in between here. So when you got in here, your idea was to try and get down to there. Okay, your idea was to try and get down here. So how do we get down here? Is we trend down here. Because if we are ranging, we will never get down there. It needs to trend. As soon as you can identify a trend, you can start looking for opportunities again. But this is your second time now. Your second entry. Because your first one was up here. You had your first idea to go short up here when there was an excursion beyond the mean and you had a qualified area that hasn't been tested yet. And then when you identified a trend, you went down with that trend and you looked for more entry opportunities based on 6 different entry techniques. And here you also looked for 6 different entry techniques because you are convinced about your entry on the top here. You're convinced that you've got a 200 pip distance and you would like to try and get some of that before it gets down to there. And how we do this section is going to be on the H4. We're going to identify the trends on the H4. So when you saw a trend line break happening, that was your first opportunity. You're now going to wait for a break and then a retest. So back to the levels there that you have, and you had it coming all the way up there. Then you saw a break of a trend line. This trend line is broken. You're looking for, but your first trade is up here. That's your first opportunity, was here to trade. Number one. First opportunity was up here. And you want to trade down to here. Now your H4, this is your daily trend line sort of a thing. And you saw it breaking. And then you jump to the H4 and you look for a retracement. And you're looking for more trades going short now. But this can only work if you can identify a trend. And we're going to use the H4 to identify this trend. And we look for stop-ons there and there all the time. The 6 different methods of getting ourselves into a trade. So we're still using our edge. We're still looking for zones. That becomes a zone now. That becomes a zone now. But our original zone was here. Okay. Let's see if we can go to a chart just to identify like a trending sort of situation. Right, let's see. Obviously, we're going to need, like if we look at this here, so this is just any chart that's opened. That's your 4 hourly. So now you have a daily sort of a trend line going up. Your first position was up here. Yeah, your first position, your first chance to get in was up here, right? And then you saw that it looks like a trend coming down. Yeah, the trend is coming down. And then you see also like a break happening up here, a trend line that's broken. So we can say this is our first opportunity, not that one. Trends are breaking now. That's a trend line on the daily. Our first entry is up here and it breaks through there. Yeah, breaks. So now we're looking around about the 4th of November or something. We're looking for something there. So if we go there and we see it's breaking through and the first proper retest is up here. And then look at the level that it's retested at. Or we're actually hiding away an opportunity. Sorry, it breaks there and it retests back up here. This is like actually a perfect one. So we are looking to go short there. But do you see it breaks the trend line on the H4 and it comes up and it retests the 12 EMA in this case. So that becomes a zone for us to look for another entry because we've already taken our first entry there. And then if it's possible, you draw whatever you can for more opportunities. But our first opportunity here has come in the form of a break and a retracement. And in this case, we only retraced up to the 12. I prefer when it retests up to the 36. But in this case, we have a trend line going the opposite way. We also have our 200 EMA that's being retested. So that is a good opportunity. So on the 11th, we drop down to the 15-minute to look for one of our 6 entries methods and see if we find something because we're convinced that we want to go short already based on our top-down analysis. Here we are, right? Now I can already see that this would probably be a divergent sort of an entry. Yeah. it's gone higher. And if I do place a RSI on there, then that's probably one. But what I'm saying is that it's broken our trend line and we are looking for an entry in that area. We're looking for something in this area to go short. So when we trained our eyes now, we've seen what we are trying to look for. You could also argue the point that you might have a circle of opportunity or a circle of liquidity in this area, because you have your breakout trader waiting, it breaks through, retracement trader up, all sorts of traders are being stopped out now, because we have our level trader, our breakout trader, and our resistance and our retracement trader all stuck in the area. And then you can go short. But what I'm saying is you look for one of the 6 entries at those zones. And then on the H4, you try and identify where your next opportunity is. So here was your first opportunity, and then your next opportunity would have been here, because you would have seen it coming up to the 36 and the 633, and then you might have failed on that one, and then you would have tried again here. We can try and have a closer look at actually what happens there as well, like there, and the other one is around about there. That's in November, right? There we have our 2, right? This one would have been a trade for us. There's the highest high, it comes down to the lowest low. It fails, or it really closes up above the 123. So it's not really a proper one. But do you see what I mean? That it closes above the area. So we like when it doesn't close above the area. And then we can go short. Yeah, do you see that? So prices makes a high there, comes down, and then it retraces all the way up to 123.6, but unfortunately closes there. So we are a bit skeptical. We don't feel happy about this one. And then we have this other opportunity over here. This is probably your RSI opportunity. Yeah, but you know you're looking for a short in that area based on what you've identified on the H4, a trend. Yeah, and once it's done this and broken through and all that sort of thing, you can see this guy here put in the lowest low, right? So you're looking for a break of this guy, and then a retrace, and then you want to enter when it clears this level to go long. But in this case, the seller was still in control. You see how that sort of a thing saves you of taking any sort of trades. Plus, you are not looking to go long anyway. Your whole idea was to go short based on your analysis. I know this is probably a lot to take in now, because there's like 6 different entry types. So for homework, I want you to, on one chart, only one chart, do a top-down analysis. Like let's do it here quickly. We start over on this one. We do a top-down analysis, meaning we start on the weekly, and then we find ourselves here. Prices are trading here. So where would we look? We can look there. We have many touches there, close to the price, and we have some touches there. And then we look at our level, and then we can see, wow, it's right on the 70. There, look at that. 74 cents is a good level. Then we have a close to price. Where has it pivoted off before? You know, it looks like it's done a massive job up there. And also it's done some sort of a job down here. So we have that as like a playing field. And what we know of the EMAs is we know that it is intertwining. So we are ranging. We're not really trending. So we might not be looking at our H4 for any sort of an opportunity because the chart doesn't seem to be trending. But it doesn't mean that we can't find an opportunity there. But when we see this, we can already look at our normal chart for an entry because we can see it's ranging. So it's better just to look on our normal sort of a chart for this. But if we drop down to the daily, then we can see that prices has come up there, and on our 36 we had an opportunity to go short. Yeah, so as prices comes up to the opportunity there, we can look for a reason to go short. So this is how the homework should be. So you tell me that you're looking for an opportunity here, and then you drop down to the 15-minute, and then there you found your area of importance. Yeah, I need to get rid of this yellow. So prices comes into the area for the first time there, right? Yeah, prices comes into that area. So now this is the area and we're looking to go short somehow there, right? So what you could do here is you could find out whether this is a 78.6 and look at how closely it matches there. You can tell me that prices made a high and that is my midpoint of my M and it only retraced up toward the 78.6. So you've qualified the M. Does that make any sense? Perfect, Alex. Good stuff. So you found an area and you're looking for a reason to get in. Prices makes a higher high. This is what you call an Alex high. Because he likes this pattern, this continuation sort of a thing where it looks like a wedge. This is Alex's favorite pattern. There, he loves this. So now he knows when it does this and there's a high there, he just pulls down the fib to the lowest part there and he looks for an M. And then he sees that it comes all the way up to 78.6. Doesn't close there, it struggles there. So it's a failure to follow through. These guys wants to go long, 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 but it fails to follow through. The trend fails. Where does it fail? That is the question. It fails at 78.6. Therefore, that is a M that we're always looking for. It's a manipulation. We're going short. So on all of these, on one chart only, just identify an area and identify the 6 different entry types for me for homework. Do you understand the homework? Where's Gavin? Okay, thanks, Justin. Good. So on one chart, identify, just do a top-down approach on the weekly and just identify the zone in which you would like to look for the 6 different opportunities to get in. Yeah, Gavin, when we rewatch this and then get your questions and stuff all sorted out, because I think the beginning of this highlighted the types of entries quite well. Thanks, Gav. Right, so I think that I'm going to call it the day now because Johirul knows that the concentration level of people are not longer than a few minutes actually, because he's a teacher. So the two edges are you find the zone. That's edge number one. Nobody does that. That's an edge for you because nobody does it. And then within that zone, you're looking for another edge. So it's two edges that we have here. And it's been working forever, and it's going to work for you as well. Right, guys, thanks very much for joining. And I don't know, the videos tends to take long to render. So I'm gonna try. I don't know. I just try my best to try and get it out as soon as possible. Yeah. So I'll see you guys in the next one. The next one is about the risk, and maybe I'll cover the 4-hourly trends again. The risk is very important, guys. Yeah. So I will show you that next time. Okay. Don't forget, trade safely and prosper.